people we can get in here today. I am going to go over and include Instagram on this live here. Give me 1 second. All right, here we go. It's coming up. All right, we are now live on Instagram as well. Let me head back over. Here we go. Let's see if we'll wait and see if some people join us here before we get started. I didn't set up an actual event. I just wanted to go live. I want to play with the software just a little bit to make sure it looks and sounds good. And once it does, and I know that it does, I'll be setting up some regularly scheduled lives so that when I'm talking and when I'm here, you'll know I'm here, so you can watch me live. However, most of these do go up. Most of these lives do go up on my feed, on all of the channels that I am on. And as you know, what I discuss is emotions and the role that they play in your investments, in your business, in the economy. What a lot of people don't realize is that the markets are always talked about in the present sense, the present tense, as if what is occurring in the market is actually what's occurring in the economy. And it throws a lot of people off because they look at the world around them and what they see is very different from what they're seeing in the market. For example, right now, inflation is pretty high. There are a lot of people struggling to make ends meet. Okay. The prices of housing is high. It's still very elevated. Interest rates are high, which makes all of those things even more expensive. And you look at the stock market and you say, how can the markets be on a tear like this? How can they be going up the way that they are if in fact they're a reflection of the economy? And the reason that markets are going up right now is not because of what's going on in the economy now, but because of what's being forecast to come in the economy. So the markets are a forecasting mechanism that are oftentimes misunderstood and thought to be in the present tense, and they're not. And when you use them that way, they look and seem very deceptive. And I think that's where that idea comes from with folks, that you can't trust the markets. It's gambling. It doesn't make any sense. Well, it wouldn't make any sense if you were looking at markets as though what is happening within them is happening now. Every time you looked at the market, you'd say, that's not a reflection of what's going on now, unless times are really good for a very extended period of time, or unless times are really bad for an extended period of time. You're right. The markets aren't going to look like they make any sense. And then emotionally, because we're emotional creatures, what happens is we stop paying attention to it. If something looks like a lie or something looks deceptive, as human beings, we're not going to pay any attention to it, because why would you? It's like being in a bad relationship, whether it's a friendship or a romantic relationship or whatever. When it turns bad and when you can't trust the other person, or when trust is lost in anything that you're doing, you no longer care to take a look at it. And when trust is lost, what you'll oftentimes do is you'll look for an expert, or you'll look for someone to give you the answer. And the truth is, in this world, it's as personal as your health. Okay. So I always do these seminars called Your Health, Your Wealth, because I believe that what the markets are for, your investments and your finances, it is for freedom, which is a big thing going on right now. Remember that your money is about freedom. It's not about money. It's not about buying things. I agree with that. Don't get me wrong. That makes perfect sense to me. But it's also about your mental health, which affects your physical health. And that's why I've stayed so passionate about it, because I wasn't born into this world, right? I was born very, very, very poor, poorer than most. I know what hungry feels like. Okay, I'm not just saying that. That's not a saying. That's a fact. So I know how much money can mean to you, just as your life, as part of your life. And a lot of times what happens is people that are maybe, even if you're born into the middle class, and it's not a judgment on if you're born with money and then a compliment if you're born without money, but there's a simple fact that goes into that. If you're born middle class or anywhere above middle class, the fact of the matter is money is kind of something that you just have, you always have. Your families they're hard workers. You don't have any reservations about it. When you've been born without money, it can be almost a scary thing. And that plays into the emotions of these markets even more. Because if it's a scary thing to you, if you're afraid that you're going to lose, if you're afraid things can go wrong, what oftentimes is it triggers in your mind, bing, bing. So the slightest little move downward or the slightest loss, and you're panicked. And that's oftentimes when people that are born in the middle class and above are far more willing to take risks because they just don't view money the same. They say, hey, look, if I lose some money, I'll make it back, right? I'll get another job. I'll do more work. Whatever it is. They just view it as this is opportunity. So I take these opportunities. Whereas someone that has started quite lower, they don't view it that way. They think it's very hard to make. It's a very scary thing. They've probably had some very scary times in their life where they had fear of not buying food or fear of homelessness or or not being able to pay the rent and having to do that whole dog and pony show with the landlord and try to stay in the house. And so it creates there's emotional attachments. And that's what I'm trying to get across right now. It's just that those emotional attachments are different for everybody. For some, much stronger than for others. And if you do have a negative emotional attachment or you have some negative experiences attached to it, it can be a frightening thing and you're less likely to take chances. And actually, it panics you far more when things don't go well. Now, why does that matter in the world of investing? Well, here's why it matters. Because most people should and hopefully do have some savings that they put into a 401k or an IRA. And what you'll see from these people that have these negative emotional attachments is they're always trying to finagle a way to make more, right? Get out of the way here, get in here. Or the truth is they're not even thinking of it in a positive light. They're probably more than likely just pulling into conservative funds when they get afraid. All right. And what we want to do is we want to, as a community of people that are saving, and you should be saving, whether it's even if you never plan to retire, you don't know what's going to come up. Maybe you want to buy a home. You're going to have a family, just to have a nest egg behind you, to have an emergency fund. You're on some level, you should be investing, right? So let's talk a little bit about, and I wanted to give you some background on those emotions, because a lot of times I will get comments and primarily through my DMs, my direct messages, that say, I understand why people are emotional, but I don't understand where the fear comes from. Or I don't really get afraid. I buy and hold and I'm fine. Well, you have to realize that everybody's different, right? But in the end, I promise you, and we've talked about how the market is structured. I'm going to talk a little bit more about it right now. In the end, that middle structure, the structure of banks, brokerages, CTAs, your wealth advisor, this kind of centerpiece, in the end, when they are selling their positions and their trading desk is selling off those positions, they will push it to a point that you will get emotional. Eventually, everyone will get emotional, as seen in 2008 and 2009. And what I want to talk about today is how do you identify when that's occurring? So how can you identify it on a grand scale? And then also, how do you break it down and identify that just in normal terms? We talked about the ebbs and flows of the market, the buying and selling. And traditionally, it is that middle group of brokerages, banks, hedge funds. Your wealth advisor works for those places, CTAs. So maybe they're futures market guys. A lot of trend followers in there. We can get into that a little bit later. But they have to profit consistently from the market. So they're constantly buying and selling positions. And what you need to do is you need to identify A, when that's happening, and then B, also decide for yourself how you want to manage that, because there's several strategies you can utilize to manage that risk. And that's what it is. The risk is yourself. The risk is your emotions, okay? Because who ends up being manipulated is not the people that understand what's going on. So when you understand the market structure, when you understand that you have that large group of middle, the big brokerages, firms, banks, hedge funds. Below them, you have your market makers that are basically creating these transactions that occur. They create a buy side, they create a sell side, and how they make money is on that transaction. They don't care who wins or loses. They're just making money on the transaction itself. And then at the very top is what you would call retail. That's your self-directed traders. That's anybody who places their own trades on Schwab. That's all retail investors. So those of you that work with a wealth advisor or a broker, you're included in that as well. You're the top tier. You're typically the ones that have the least amount of knowledge and know to a lesser degree what is actually happening. So what I'm doing is I want to educate you on how that works and then how to identify some of these points of inflection, because no one's going to tell you. So let's talk about that, because there's a couple of ways to identify what's going on. So let's explain the difference very quickly of the difference between retail, that is the average person who works with a financial advisor, has a 401k, versus a brokerage firm or a hedge fund or a group of CTAs, which typically work in futures, wealth advisors. What's the big difference? I mean, what would everyone say the big difference is? I know one thing that we can say is a very big difference is the size of those groups. So they're much bigger, right? And they leave a much larger footprint, so to speak. So if you are buying 10 and 20 shares at a time, even if you have a large account and it's 1,000 shares at a time that you are trading, these people are trading in blocks. A block is 100,000 shares. So when you buy and sell 100,000 shares, it's noticeable. It shows up, okay? Now, how does it show up? Well, what's the one way that you are able to read a market? So able to read it live. It's a chart. And that's why you'll see so many guys online showing you charts all the time. They're showing you charts because it's not that it looks very boring to you, I'm sure. But the truth is most people don't know how to read a chart. A chart is nothing more than a live book. So everybody enjoys a book, right? It tells a great story. It gets you excited. You dislike the antagonist. You like the protagonist. It has an amazing, like the topic is awesome. At the end, you find it wraps it all together. That's what a chart is. It's a book, right? The difference is it's not written in English. I mean, it is. If you're in the U.S., it's written in English, but obviously we have, there's a lot of languages books are written in. I'm saying English because I am from the U.S., but so it's not a language that most people know how to read, and they never learn how to read it. But the truth is, what a chart does for you in a live format is it allows you to evaluate what's happened, the history. It allows you to evaluate what's going on now. And what that allows you to do is draw some fairly, if you understand what you're looking at, you can draw some fairly good forecasts. You can understand to a pretty decent degree what is coming, and you can create some very high probability situations by reading this book. And so what I tell people all the time when we talk about a chart is don't think about a chart as those lines that you're seeing. All right. There's a lot of people that put a lot of stuff on their chart. And let me explain what that means. So you'll see all these indicators, right? You'll see the MACD. People will talk about Bollinger Bands. They'll talk about moving averages. Those are a few of the biggest ones I see. You'll see Fibonacci retracements. People are putting this stuff up all the time. Let me explain to you what all that is. I call it noise. And why do I call that noise? Because what those tools are, those indicators are, they're like training wheels when you're learning to ride a bike, or it's like trying to sound something out that you don't quite understand. So when you first start reading English, you don't just jump on and read supercalifragilisticexpialidocious, right? You don't know how to read that. So you have to sound it out a syllable at a time. And that is what indicators are. And this isn't to judge anyone, but when you're using that stuff, what you're really doing is you're sounding out the syllables. Okay. Now, if you're really zoomed in and you're a day trader, you're somebody who's trading, by the minute. I'd like to say something about day trading very quickly. for everyone out there if you're thinking about trying to do it or you think it looks exciting. The truth is that's a very boring job that I couldn't imagine doing all day. It's awful. Staring at a screen all day, and most people aren't capable of it. Two, to be a day trader and to have the discipline to actually be good is far more difficult than what you're seeing on TikTok, I assure you. Three, their accuracy level is very low. It's barely over 50%. So emotionally, being a day trader is extremely taxing, and you have to know that it's extremely taxing, not to knock it, but to understand it. It's a job, and it's a high intensity job. Now, they may use some of the indicators that I'm talking about now simply because that's how slow the book is that they're reading. So the words aren't coming out all at one time. The sentences aren't coming out all at one time. The paragraphs aren't coming out all at one time. It comes out slower. So they are reading in syllables. So for those guys and for those people and for people interested in doing that, I want you to know that when you see that, you're going to have to ignore some of this commentary because they are reading words that aren't complete yet. They're coming out little bits at a time. And when that happens, you do need assistance. You do need something to help you with certain levels. For the rest of you that are looking for long-term investments that just want to miss the big bear markets, they don't want their emotions taken advantage of. They don't want to sell at the wrong time. They don't want to buy at the wrong time. And maybe that's for something long-term, or even swing traders out there. You will not need those things. Okay. When you follow along with me, when you're learning with me, if you take one of my courses, you're not going to need that stuff. Okay. You're not going to need those indicators. It's unnecessary. I will show you how to read this chart like a book, and it will tell you a story. And here's how it tells a story so that you can be clear. This is a story that you have to decipher a little bit. And how you decipher that story is you take a look at history and you're slowly going to move yourself forward. And what happens is the story unfolds for you into today. And you'll finally have an opinion. Okay. You'll finally be able to say, hey, I have an opinion. So we were talking before about the footprint of these banks, brokerages, these bigger traders, hedge funds. We were talking about their footprint and that it's a large footprint. How do these footprints show up? Well, if you even take my very first course, you'll see that my chart setup is the easiest chart setup that you can imagine. It is simply price and volume. That's it. We use bar charts, and we're looking for price and volume. Okay. Why? Well, for those of you that don't know what volume is the number of trades that is taking place. So you're looking for the number of trades that are taking place at any given time. So if you're looking at a monthly chart, it's going to show you 1 month at a time, and it's going to show you how many trades took place. If you're looking at a weekly, it'll show you a weekly bar. Monthly is a monthly bar, weekly is a weekly bar, daily is a daily bar. And then as you get, 1 hour bar, 30-minute, 15-minute, so on and so forth. So these individual periods are just periods of time. And what volume is it shows you how many trades took place in this period of time. The reason that is so important is because guess what? 100,000 shares traded in one block by that middle group, that center group, is noticeable. You can't hide that. You can't hide it. When you trade on the open market, they talk about dark pools. Listen, people talk about a lot of stuff. I can tell you this right now. The big shares traded are identifiable. You can see them. And I'm going to go probably in my next live. I'm going to go through a little bit of charting just to show you. But I don't want to be. I want people to understand what they're looking at before we start that stuff. So again, why do we look at volume? Because you can see their footprint. What's another footprint you can see if you're trying to identify where retail is going to react emotionally, and that second tier, big banks, brokerages, hedge funds, are just placing their trades. They're buying and selling as they do to make a profit. Price. That's why those are the only two things on my chart. Now, how is price affected? Well, let me ask you. This is simple. you'll know this right away. If I had $1 million and I went and I was looking at 2 homes, and you came in and you had $100,000, and I purchase, I buy one of those homes, you buy the other one of those homes. What happens to the price of my home versus the price of your home? Well, the price of my home is going to be based on $1 million sale purchase. Your home is going to be based on $100,000 sale purchase. So I am already worth more than you are. My price has elevated far beyond yours. Not because my home was worth more or less, or your home was worth more or less, but simply because I put more money, I bought / I purchased that home, and I put more dollars on the table. So if you translate that into a chart, into the story of the market, what that creates is a bigger price move. And if you're looking at a monthly chart, a weekly chart, a daily chart, what that's going to do is create a much longer bar. So you're going to have this very long bar with this very big volume bar that identifies a lot of trading occurred and a big price movement happened. Now, okay, so there is one very easy way to identify when we can call them the strong hands, we can call them what they are, which is banks, brokerages, hedge funds. They're big buyers and sellers in the market. That's what they are. Big buyers and sellers, big money, bigger money. It's just a way to reference them, right? That's one way you can identify big money, banks, brokerages. So now that you've identified them, so now we're looking and we have our investments and we identify this thing that has occurred. Okay, what we're going to do now, and this is the beauty of a chart or the story, the book of the markets. What we're going to do now is we're going to look backwards and see where that took place. So this is going to sound ridiculously easy because in fact it is. So we look backwards and we say, okay, this is ABC stock, right? Symbol ABC. Doesn't matter what company it is. We see all this big volume come in. That means a lot of tradings occurred. We see price go from $20 to $30. Traditionally, price is moving from 20 to 21 at a time. It's moving $1 at a time. This time it moves $10, right? On this big trading, all this trading has occurred. We look backwards and we say, gee whiz. What am I, my grandfather? That's funny. We look backwards 6 months and we go, oh my goodness, this was only trading at $7 6 months ago. And guess what we see 6 months ago? We see the same thing that is occurring now has occurred 6 months ago when this was trading down at $6 or $7. We see large volume, a lot of trades occurring, and we saw a big price move. And after that big price move, after it went from $6 or $7 to $10, it just floated on up to 20. Now all of a sudden it hits 20, and there it is again. This big footprint, these large amounts of trade, this big price move has occurred, and price goes up. What can we surmise from that? Well, we know that that wasn't retail. We know that that wasn't people buying and selling in their own account, because the fact of the matter is there's just too much volume. There's too much trading that's occurred, okay? So we know it's that middle section. It's banks, brokerages, hedge funds. And we know that they have this trading desk, this group of professionals that basically buy and sell stocks, bonds, commodities, futures to make a profit. Well, that stock ran up a little over 100%, and now price is taking off. We can surmise that what has occurred is very simple. Sorry about that. That's a golf cart. I'm on a golf course. We're living on a golf course at the moment. So what we can surmise from that is they are now selling. And guess what emotion that is going to evoke into someone in retail? Well, I can tell you the emotion it's going to evoke. You, wow, we're up 100%. Look at price going now. Now it's up to 30, right? Oh, wow. Oh, my goodness. From 10 to 20 and now from 20 to 30 so quickly. It's excitement. It's fear of missing out because the media, not, look, there's some manipulation that goes on, and then there's also some just activity. The media is going to report on a stock that's up 100%. And if it moves at the rapid pace that I'm describing to you, it's going to report that because it went from 10 to 30 in a year. So this stock's up 300%. They're going to report that it's up 300%. Now, you can view that any way you like. If you want to view it as though that's propaganda and it's being pushed at you, well, there is salesmanship, right? There is, because these larger banks and brokerages and hedge funds, they do pay to go on to Bloomberg and, you know, onto the NASDAQ, and they do pay for these things. So you are going to get some commercials, but ultimately what's going to happen, regardless of how the information gets to you, it's going to get to you, and you're going to feel like you're missing out. And what you're going to do is you're going to start buying. And once you start buying, that trading desk is selling to you. So let's talk about why when a lot of times when you purchase a stock that's gone up like this, why it'll go up 5 to 7% and then just turn over and just drop. Why did it take so much time to get there versus the speed at which it nosedives down? Why is there a difference in those two speeds? I'm going to talk about that in my next live, and I'm going to do my next live in, let me take a look here. I'm going to do my next live in 45 minutes. So I'm going to post the event now, and I'm going to do it in about 45 minutes. So I will see you all very soon. What I'm going to talk about is why it takes so much longer for prices to rise and why they seem to deteriorate so much quicker. So if that interests you, I'll be back in about 45 minutes. Thanks for tuning in, and I'll see you soon.